Today we wanted to talk about annuities and lifetime income riders. Hi, my name is Pat Kerfoot. I'm a certified financial planner. I've been in practice over 15 years. I will be your host today. Remember, this is an educational program. It's not intended to solicit the purchase of an annuity or an insurance product. The presentation is intended as a brief overview of the general features of these products. Is not intended to advocate the purchase of any specific product. I'm not giving specific tax advice or specific financial planning advice. Let's review a little bit. Why do people buy indexed annuities? A lot of people lost money in 2000 and 2008 when the market tanked. As they retire, they realize their number one goal has to be to protect their principal. This is their retirement nest egg. This is the money that's going to last them for the rest of their life. They can't afford to lose money. These people are also concerned about how volatile markets have become. And even though they're looking for a safe place to put money, they still have to have a reasonable rate of return. And this is exactly what fixed indexed annuities are designed to do. Remember that this is an insurance contract. The interest credited into the contract is based on the performance of a market index. So the typical annuity contract will have several indexes to choose from. Depending on the performance of that index, interest is credited to your account. That interest locks in each year, and it can't be lost in future years if the market turns down. Now remember, this is an insurance contract. It's not a securities. Your money is never actually in the index. Your money is not really purchasing the market. This is an insurance contract that credits interest based on how a market index performs, and it provides tax deferral. Gains are not taxed until they're withdrawn. Why do people want a guaranteed lifetime income rider? Well, remember what the number one fear retirees have, and that's that they're going to run out of money, that their money is going to expire before they do, that at some point they're going to be left without any assets. The guaranteed lifetime income rider guarantees payments for life. Guarantees payments for life. So that addresses that number one fear that retirees have. Typically, they will have a guaranteed roll-up, that every year the value of the contract rolls up by a specific percent, 5, 6, 7%. The guaranteed payments are based on age. Many of these contracts will have a chronic care rider. And one thing I always talk about is the fees charged. Remember that most annuity riders will have a fee. So when you buy a rider, make sure you know what the fee is, make sure you know what you're paying for, and that the fee is appropriate for the benefit that you're going to receive. Now, let's explain how a guaranteed lifetime income rider works. Essentially, what you have are two parts of a contract. I'm going to call this account the base annuity account. Its value is going to be based on the premium paid, the bonus that you have, then the accumulated interest credits, minus withdrawals and fees. So let's talk about that. The initial premium, the money you first put into the product, plus the bonus it's paid. Then there's the accumulated interest each year. Fees are paid out of that, and any withdrawals are paid out of that. So this is really what I want to call the cash account or the investment side. This is where your money is. Then there's an income rider account. Now the income rider account is not a cash account. This is not an investment account. This is the way the company determines how much money they're going to pay you at a given age. So this is the cash account. This is the investment side. This is the income side. The value here is based on the initial premium paid plus the bonus plus the guaranteed annual roll-up. So remember I said contracts can have an annual roll-up of 5, 6, 7%. That's where this is occurring. I've had people come to see me who say, well, I have an annuity that's growing at 5, 6, 7, 8% a year. They think that's occurring over on this side of the contract. In almost every case, that's not true. That roll-up is occurring over here in the income account. So guaranteed income payments are determined from the value of the guaranteed lifetime income rider, but they're going to be paid out of this account. Okay? Now let's suppose you activate your rider, you're paid for a number of years, those payments are coming out of this account, and then you die. If there's a balance left in this account, it goes to your heirs. Let's say you access the guaranteed lifetime income rider, excuse me, over time, your base account goes to zero, the company keeps paying you. That's why we say it's a guaranteed lifetime income rider. Once you start it, these payments are made for the rest of your life. If there's any balance in your account at the end of that period, then the account is paid to your heirs. If you live long enough that you go through all of your money, you're still going to be paid that guaranteed lifetime income amount. Now let's look at how this process works. Let's suppose we start with an initial premium, $100,000 paid at age 60. Let's suppose there's a 7% bonus, 7% annual roll-up, and I'm just going to suppose this occurs for 20 years. So at age 70, the income account has grown to $210,485. Okay? The initial premium with the 7% bonus rolling up at 7% a year. Notice how that account rolls up at 7% a year. Okay? Then there's a payout percentage, and this is part of the contract. I'm going to assume at age 70 a payout percentage of 6%. In this contract, I'm going to assume that that payout percentage goes up each year. That does occur in many contracts, that the payout percentage will go up each year. So at age 70, we take 6% of $210,000. It's $12,629. This is your annual payout amount. It can be paid monthly, it can be paid quarterly, but this is how much you're going to be paid a year for the rest of your life. When you die, if there's money left in your contract, that goes to your heirs. If you live long enough that your contract goes to zero, this is the guaranteed amount that's still going to be paid to you. Now you notice each year this amount goes up. That depends on what year you access it. So if you were to access it at age 72 and instead of age 70, you notice you're being paid $14,941 instead of the $12,629. If you wait till age 75, you would be paid $19,189. So again, the account value times the payout percentage equals the amount of money that you're going to be paid each year. Why would people purchase an income annuity rider? Well, remember what we said. The number one concern that retirees have is the fear that they're going to outlive their money. That at some point their money's going to dry up, their money's going to be gone, and they're not going to have any assets. So the guaranteed income rider addresses that number one fear. The way I utilize an income rider with my clients is to say, well, let's maximize the Social Security benefit you're going to receive, add a guaranteed lifetime income rider to that benefit, and create a baseline retirement income. So I call this a retirement paycheck. Think of it in this way. When you were working every month, you knew what your income was going to be. you had a paycheck coming in each month, and you could budget your expenses based on what that paycheck was going to be. When you retire, wouldn't it be nice to create a retirement paycheck? Determine what your expenses are going to be, maximize your Social Security benefit, then use a guaranteed lifetime income rider to create that baseline income you need when you retire. What that does is it helps you to better utilize the other retirement assets you have. The fact that you've put a retirement paycheck in place gives you a sense of peace, makes you feel more secure, and as I said, helps you to better utilize the other assets you have. Many of these riders will also have a chronic care rider. I don't want to talk about that today. I have another video on YouTube about chronic care riders, and I suggest you refer to that. Finally, is a lifetime income rider something you should have? My number one question becomes, are you afraid you're going to outlive your money? Is that a concern for you? If it is a concern for you, a lifetime income rider is a great way to address that concern. Think about what it is we're trying to do. We want to coordinate your Social Security benefit with an income rider to create that monthly cash flow. We want to give you a guaranteed income per month. I believe that once we do that, you can better utilize the other retirement assets you have. Once you know what your monthly cash flow is, you can understand better how to use the other assets. Also, are you concerned about long-term care? Are you concerned about trying to provide for chronic care? Because in many cases, an income rider can help to supplement your long-term care insurance or help to provide for chronic care. I hope this has been of help to you. If you have any questions or would like more information, please feel free to contact me.